Welcome to another edition of Market Marauders. Beating the market one trade at a time. First things first, hit that subscribe button down below, like, comment, and share. So today I'm giving you my top 3 options picks for the week. So let's dive into it. So for number 1, I have Google. Google's is above its current moving average 50 and moving average 200. Its moving average 50 is 1375.63, and its moving average 200 is 1233.48. And where it ended on Friday, its price was 1434.23. So if we jump into another chart on here, we can see, at least in its 1 day movement, it went pretty low. It went down from 1466 down to 134 or 1434.58, but I think it has the potential to go back up in a pretty dramatic way. So if we go and look at, this is in the Robinhood app. I got a link down below if you guys want to join Robinhood. You get a free stock if you sign up using the link. So that's an incentive to sign up for it. That's where I do all of my options trading on. And they also trade just regular stocks through dividends for you people who are new to investing. So Robinhood's a good app to use. They have a lot of helpful information on there, and there are other websites, other apps. There's Webull, Tastyworks, but I don't use those platforms, so I just use Robinhood. It's a lot simpler for me, and I've used it for a long time, so that's what I advocate. But anyway, jumping into the Robinhood options. So on Robinhood, you can check option prices from where they closed on the week, give you, or on the day even. It'll give you a rough estimate. For those who've never traded options, these prices aren't fixed. They move and fluctuate with the market. So depending on where the market was or where the market price is, these are going to be the prices for the contracts and what they're going for. So these are all based on this one price of 1435.10, but as you know, the stock prices when the market's open never are stagnant. They're constantly moving. So this is just a rough estimate of what you'll be paying for a contract. So if we look at the calls are in red, and that's just because the stock was going down for that day. It kind of dropped off, but these are what the contracts are going for. Now, I personally wouldn't get one that ends on Friday, the 7th. I'll probably get one that is gone out a little bit, so probably the 21st. And I'll look at these prices. Look at something that you can afford. Don't go too crazy. Pick a price point, and if you can afford it, buy it. If you can't, then try to look at another stock for something that's affordable. There are always deals out there in the market. You just gotta find them. Just do a little research, and you can find deals. All of them aren't as expensive as this, but usually the more expensive the stock is, the more expensive the option call and put is. That's just generally how it goes. And the more you go up here to have a call that's more out of the money, the cheaper it is. But that's just because the likelihood of it getting to this is not as high as the ones that are down here. So down here, these are more expensive because 143.37.50 is a lot closer to 1435.10. So basically, these options above here are out of the money options, and these options down here are in the money options. So out of the money just basically means it hasn't gotten to this price, but you expect it to get to this price. In the money options down here basically mean that you think the price has already gotten to this strike price. So since the price has already gotten above 1482.25, then That's where this line is drawn, and these are in the money options. Now you can still be in the money even though it's in red, because the market fluctuates so much. But if we go to the put side, all of them are in green, and that's just because it went down. So the likelihood of that continuing, it makes them all green because they're reflecting directly what the market is doing. So that's just a small little briefing on options, calls, and puts. Uh, Call is basically saying that you expect the stock to go up if you buy a call. If you're buying a put, it means you expect the market price to go down. So on Google, I'm gonna say a call, to buy a call for Google because I expect the price to go up. Um, and the reason for that is because of this. So on February the 3rd, Google is going to be having its earnings. And, you know, if we look at the trend of what's going on in the stock market with a lot of tech companies, they've been going up quite a bit. If you guys have been following Amazon, it shot up. I think it was like 230 something dollars in one day, and I expect Google to continue to grow based on their earnings. I think once people see their earnings, they're going to rally around that, and the stock price will go up even more. If you look at the chart, it's been trending up since about October, and there's had this little lull for about a week or so, but I think it's going to go back up once those earnings come out. And if we see this pattern has been duplicated multiple times. So showing this little trend down here shouldn't negate investing into an option call. So if you look right here, it has the exact same pattern as right here, which is the exact same pattern as right here before it broke out. And then it's basically, this pattern has followed it basically every month. So in November it had a drop off, but then it broke out. And then December had a drop off, breakout. The beginning of January, drop off, breakout. And then the end of January, which it is, uh, which was last week, drop off. And then I expect it to break out again. So I expect that trend to continue moving forward, and that's why I have them as my number one call on here. And these aren't in any specific order, by the way. That's just the first one that's on here. So going into number two, I have Boeing. So for Boeing, I'm going to say a put on Boeing. Boeing has had some really bad news recently. They've had a lot of problems with their 737 MAX. If we go into their chart, they've dropped off, they've been up, they've been down. They dropped off a lot. So going into this chart, we can see they dropped off quite a bit. They went down from about the middle of November around Thanksgiving, and they just kept falling. And this is due to the fact that the 737 Max just had so many problems. They've had to ground so many planes. They've gotten a new CEO in the time, but they still have problems with the planes and with delivering on planes. So planes is mainly what they do. So if the problem is with the main product that they produce, then that's a major problem. So if we go down here and look at this chart, if we look at the 1 day chart on here, we can see that it was all the way at 321 and it dropped all the way down to 318. So it went even to like 317, and then it kind of bounced back up, but then it started going back down towards the end of the day. So I think this trend is going to continue going down, and I would say to put out a put option for this because I believe it's still going to continue to go down. Now, if we look at these aren't as expensive as the Google ones, and we can see that's just because the price is only 318 or 320 something dollars for the price, and compared to the other one, it was like 1400. So they definitely reflect the price of the actual contract. Now, going into this is actually the reverse of the call. So if you look at a call, the top portion is in the money, and the No, the bottom is in the money and the top is out of the money. But if you go to a put, the bottom ones are out of the money and the top ones are in the money. So they're kind of inverse of each other. So if you look at this one, 312.77, it hasn't gotten to that price yet. So, these will be considered out of the money options. Uh, so because it hasn't dropped down to this price, we can see as you scroll down, the options just get cheaper and cheaper. Also with options, you have this price. This, for one option, it is the contract to buy 100 shares of a company at a specific price. So take this number, multiply times 100. That's how much you'll pay. So if you go down here, you're not paying 28 cents for the contract. You're paying $28 for the contract. Here you're paying $23 for the contract. $37 for the contract. So that's how basically you can factor the price. So you see this $9 right here. This is $900. So that's how much you're going to pay for this one contract to buy Boeing at 316. Now, these above here are in the money options, which means it has fallen below. Some of these are out of the money. Okay, so let's scroll up to the top. So 318.15, it's gone below that. 317, it hasn't gotten to that. So some of these are still out of the money, but they're on here because they're very close to being um, in the money. So if you look at the price, 318.20, it's pretty close to that. It's like 40 cents away from that. So that's why these are up here, and that's why they're more expensive. So 317.67 is a more realistic price that it can get to. So that's why these are up here. Down here, 287. It has quite a ways to go to get to that. So that would be definitely considered an out of the money option. So out of the money basically is anything that has gone to that, hasn't gotten to that price yet. So 315, even though it's above here, the way Robinhood has it set up is a little weird. It's still considered out of the money, even though it's in green, and that's because it hasn't gotten to this price. It hasn't fallen down to 315.10. So having this 318 price, this is still considered out of the money. But these up here would be considered in the money because they have breached that price of 318, 318.60. So all of these, would be considered out of the money still, but they're closer to being in the money because, and considered in the money because they're very close to getting this price of 318.60. So the closer the stock is, the to being going below this price, the more in the money it is for a put, and the closer it is to being above the price for a call, the more in the money it is. And then the further away it is from being below that price for a put, then the more out of the money it is, and the more closer it is to being away from that price, the more out of the money it is. So it can be a little bit confusing, but once you get the gist of it, it'll make sense. Just look at the price right here, 312 strike price, and look at the price that it is per share, so 318. So you're saying you're going to pay $473 betting that it's going to get to this price by this date. Each contract has an expiration date, so this is the date that your contract expires. If you don't exercise that contract, which means if you don't pay for that contract to get those shares, or you don't sell the contract, then your contract will go to zero, which means that it'll be paid nothing. So $0 is it'll negate the contract. So you want to get that contract and either exercise it or sell it when you get it. So that's the whole point of that for options. If you guys don't know, it's just a small crash course. I'll probably be doing a video in the future explaining options a little more in depth, but that was just a little crash course. So Boeing is my number two pick because they had their earnings, and their earnings were really bad. Their earnings on the 29th, which is a few days ago, was last week, and if you see their revenue went down to 17,911 compared to 28,341, which is a significant dip, 37% change it says on here. And then for their full year, they went down to 76,559 compared to 101, 127, which is a 24% change. So basically, they went down a whole year, 24% in revenue. And for their fourth quarter, year over year, which basically means compared to last year, they basically went down 37%. Now, these are not small percentages when it comes to a company, especially a company whose revenue is 17.9 billion. So that is a large amount of money and a large change in money, and shows that they have lost quite a bit of money. And I think that that's going to affect the stock price, and I think shareholders are going to sell a lot more because the performance of the company was so bad. So that's why I say is my number two pick for a put, because I think this is going to continue to fall and fall pretty far until at least their next earnings, or that they have a press release showing that they have fixed the problem with the 737 Max, or some other project that they have going on that can give investors more, more confidence that the company is a good buy. So going into my number three option, I'm gonna say is Disney. Even though Disney, has gone down a lot since in November, it kind of went up. This is around the time Disney Plus came out, so it shot up, but it's gone and fell down. It's below its moving average 50, which is 145.24, and it's almost below its moving average 200, which is 137.66, but it's at 138.31. So jumping into this also shows another chart on here, but it shows growth. So if you look at this chart, you can see that it has grown, even though it's had its dips. It's still been growing. If you go to its 5-day chart, it's still growing, even though it's had its dips. Its dips are pretty significant, going from 138 to 135. It's only like a $3 difference, but it's come back up, and it's on its way back down, but I don't think that's gonna uh, happen considering its earnings. So if we go into here, this is a press release basically stating that Tuesday the 4th, they're gonna have their earnings, their first quarter 2020 financial results. So these results, I believe, will have the impact of Disney Plus and show the numbers on that. So it's a pretty important press release, as well as pretty important earnings for Disney, because we had Netflix's previously and showed that they had a lot of international growth in terms of amount of users that they have, but Disney Plus we're basically gonna see how Disney Plus has performed because we saw how Netflix performed. So going into that, I think it's gonna be a pretty important call, and I think I'm gonna say to make a call, uh, an option call. This is what I would do. I'd make an option call on Disney. Uh, I wouldn't make it on the 7th, but I would probably project it out for a little further, just to give a buffer for it to go up, and people to let that sink in. When following stocks, the news kind of lags the price kind of lags the news. So you know news may come out, earnings may come out, but it usually takes like a week or so for the price to directly reflect that. I think people just have to take time to let the news sink in, or read it for themselves, or watch a video about it to see what was really going on. But that's just how it seems to be for me. Now, some news that's very dramatic. Um, that'll directly reflect the market. But sometimes news, especially something as important as earnings, I think that may have a dramatic effect. People usually rally around it before, and then afterwards, people kind of buy in a little bit at a time, or people who get the news a little early who buy it a little time, and then you'll see it kind of spike up. So I think that's what's going to happen with Disney. I think people sold off a lot, but I think the numbers for Disney Plus and all the movies and stuff they've been making will be a positive thing when it comes to their earnings and all the moves they've been making moving forward. Because they've made a lot of moves as far as films are concerned and their whole streaming service. So that's why they're my number three pick. I think having a call for them would be pretty good. And it'll be a pretty good lucrative move, especially considering that they had at the end of the week they had a lull where people were selling off more of it. I think earnings it's a good time to jump into it for a call, or if you want to buy the stock, that's a good thing too. Um, but those are my number three option picks. Make sure you hit that subscribe button down below, like, comment, share, and I'll see you guys next time. Peace.